The stock market always goes higher, right? Well, what if this time is different? What if we get stuck in a long-term bear market where the market continues lower for years to come? Well, this is not a far-fetched idea because this is already happening in other countries. Talking about how some other major countries' stock markets have not hit all-time highs in over 10 years. Taking a look at some other countries' stock markets and talking about this simple premise that the market that we believe will always go higher, it might not. Talking about it here in this video, so make sure you guys stay tuned. What's going on, guys? Patrick here, and today I want to talk about an idea. Possibly the market could not go back to all-time highs for many years to come. I want to talk about how this is happening in Japan, how Japan's stock market has not been back to all-time highs in over 20 years. So imagine investing in Japan in the market back in the 1990s when the market was at an all-time high, the market crashed, and then ever since then it has not gotten back to that point. We as investors, as Americans, as people always believe one truth, that the stock market is always going to go higher. But the problem here is that what if the market does not go higher? So if you look what happened in the 1970s, the Dow did not make any new significant highs in between 1966 and 1982. That's 16 years. So if you talk about inflation, you look at the overall market, basically people investing in the market were losing money during that time for holding. For holding during that time, you didn't make any money. Now, obviously, if you held till now, 50, 60 years later, that's one thing. But let's be honest, how many investors today are really looking to hold for 20 years? Now, looking at Japan's stock market, the Nikkei 225, 30 years later, and they still have not gotten back to all-time highs. If you look at the Euro Stock 50, which had their highs back in the 2000s, which was 20 years ago, they still have not reached those highs again. So looking at other countries, looking at history, you have to ask yourself, well, what if this is similar? Now, I know people are going to be like, yeah, but the Fed's buying, the Fed's buying, everything's fine, the market's going to get pumped back to the moon, it's all going to be gravy, and everyone's going to be happy, happy, happy. A lot of people talk about dollar cost averaging. People are like, hey, worst come to worst, I'm just going to keep buying and buying and buying because I don't care. I'm just going to long-term invest. Here is the question, right? Here's the question. If you have $10,000, you invest $10,000 dollar cost averaging for the next year. In 2021, the market continues to go lower. So you put $10,000 in the market, now you have $5,000 because the market has continued to go lower ever since you started dollar cost averaging. At what point do you end up either selling or taking your money out of the market? Do you double down? Do you add more? Do you hit that threshold where you just can't hold any longer? You need to see some type of returns on that money. Now, we're going to the point where we basically have no interest anymore, probably going to end up with negative interest pretty soon. I don't really see the hedge here anymore. I don't know where the hedge is. Gold hasn't really been doing much. Cryptocurrency hasn't been doing much. The market's been bouncing. Obviously, we should expect some bounces along the way. The market drops, the market bounces back. If we really look at some of the other historic patterns in the market, we have seen that plenty of times the market has went from all-time highs, dropped down, and then went sideways or trended lower for 3, 4, 5 years minimum. Can you keep dollar cost averaging for the next 5 years? As an investor in the modern day stock market, for the last 20 years, you basically could have bought every single crash and then sold for a profit a year later, 2 years at max. That's a very interesting conversation to have because everybody is so ingrained in their heads. Everyone has this idea that if I buy the crash, I'm going to be fine and I'm going to sell for a profit a year later. Maybe 6 months, maybe 3 months. Some people bought the crash recently and sold for 100% profit on like Royal Caribbean, things like that. But as an investor, as a retail investor who's just, not really looking to trade, but looking to invest, at what point do you stop dollar cost averaging? Now, there's an argument that we are in an asset bubble. Back in January, February, the market was basically hitting an all-time high every single day. It was just going higher and higher while there was this whole pandemic discussion, while stuff was going on in China. All this stuff was happening and the market was just going higher and higher and it made no sense at all. And then all of a sudden the market crashed. If you would have been buying at the 330 area, thinking that the market was going to continue to go higher and higher, you're hurting right now. Now, again, you know, if you're investing long term, you're probably going to end up okay here. But what if we're not okay? What if we end up not being okay? So right now we have a massive shock to the overall economy. You know, we've got problems with supply chains. We've got the service economy just totally wiped out. Restaurants, bars, they're not there anymore. If you look at the overall market here, you look back the 100-year trend for the Dow. If you look at the 100-year trend for the Dow, you can see these overall corrections, how they've happened, and also this overall trend line. We're still far from that 100-year trend line, which a lot of people look at like, hey, you know, Great Depression. We've had other pullbacks to that kind of overall trend line, and there's also different ratios people are looking at right now. So you look at the Shiller P/E ratio. That's basically saying what the companies are worth and the actual price of the stock, and really looking at the numbers. If you look at this ratio right now, and you look at that ratio between the longer term stagnation in the 1930s and the 1970s, right now we are at a 26. And when the economy was in great shape, low unemployment and higher consumer confidence, that would basically look at like a 70% drop in overall stock devaluation. Massive gap in overall valuations even after this decline. So where we are now is still not at a point where it's like, wow, this is an amazing opportunity. The market's at an all-time low. It's amazing to buy now. Fed just keeps going crazy and just pumping. There's got to be some type of end game here, right? What's the end game? You can't just keep pumping until, you know, the cows come home. This is exactly what happened in Japan. The Japanese stock market peaked in 1990, and then ever since then, they've been trying everything they can by printing money, by trying to pump the price of the market, trying to pump bonds, all these different things, trying to do anything they can to pump the GDP. Obviously, Japan is a great example of how you just can't keep buying, adding and adding debt, and trying to make the market get back to an all-time highs. Obviously, the USA is different. We're a major player we pretty much are the players when it comes down to the overall markets, the overall world. Everybody is looking at the US economy as a benchmark. But if you look at like a company like Dave & Buster's, they bought back over $63 million of their own shares in 2019. And where did they get that money to do that? They got that money from loans and debt. That pushed their price to an all-time high because they were buying back their own shares. So you really kind of create this overall bubble where the people don't actually understand the fundamentals, where the actual retail investors don't understand that Dave & Buster's are actually buying back their shares, trying to basically pump the price of their own stock. Looking back at what Japan did, they had this massive uncontrolled money supply and credit expansion in the late 1980s. And at that point, after the market peaked in the 1990s, it all came crashing down, and they weren't able to recover from that because they basically threw everything they could at the markets. Everybody was high happy, and then the market crashed. And it really, at that point, there was nothing they could do other than just create more money out of thin air, exactly like we're doing right now with the Fed. So you have to ask yourself, as the market is crashing, everything's looking bleak, the Fed comes out and says, hey, we're going to put $2 trillion, we're going to buy junk bonds, we're going to buy everything, we don't care, we're getting long everything, we like it. If the Fed is the only one who's buying, what's really going on here? Are they just creating this false sense of security because they know that if they don't step in to buy, the market's going to get hammered, and at the end of the day, they're just trying to keep, you know, these corporations in business, keep everybody in business, giving out free money to everybody. So at what point do we just hit a wall where we just can't go any higher because there's no more buyers left? At some point, big money has to start selling to take some profit. There's got to be some buyers there to buy. So you're looking basically to dump on all the retail investors. What happens if they don't? So if the market continues to go lower for the next 2 or 3 years, you know, we're going to have drops and pops, and your dollar cost averaging during this. At what point do you stop dollar cost averaging? At what point do you lose hope? So you have to think about the overall economy, the idea of people just putting money into a trading account and trying to invest, at some point, those people are going to run out of money. They're not going to be able to keep dollar cost averaging. That's when we get to an accelerated point where the market just continues to go lower because people are just getting hit and hammered and they can't keep absorbing losses. So what if the Japan situation is really just a precursor to what's happening in the USA today? Japan did everything that we are doing now with low interest rates, with monetary easing, all this stuff. They're putting money into the market and they still cannot get the market to go back to all-time highs that they experienced in 1990. Ask yourself that question. Again, like I always say, the market can stay irrational longer than I can stay rational with, the money in my bank account. It's not about me being short or long at this point. It's just about trying to see the different opportunities and trying to figure out what's going to be the best opportunity for my money to make a return. Do I start dollar cost averaging with the hopes that the market's going to go back to all-time highs? If I do that, what do I do if the market doesn't? Can I continue to dollar cost average for the next 2 or 3 years until we can finally find an official bottom? Is that realistic for me as an investor? Is that realistic for me as my capital, investing my capital in that way? So these are all things that you should be asking yourself when you're investing or when you're buying stocks, long, short, whatever it is. You should really be asking yourself, what's your overall pain tolerance? It's one thing to believe the market's gonna go back to all-time highs one day. It's another thing to actually be able to hold through, a rocky, bumpy road. And I fully believe we're gonna have a rocky, bumpy road before getting back to business as usual. So there it is. Is Japan an example of what could happen here in the USA? Let me know down in the comments down below. Talk to you guys later on.